Welcome back. We are now in segment 6.9, and in this segment we'll be discussing about deferred tax liability. So far we have discussed various items under the liability side of the balance sheet, right? And we already discussed that we are right now in the term liabilities portion. So the liabilities can be broadly classified under three major heads, right? That is the owner's funds, term liabilities, and the current liabilities. We have almost completed term liabilities. This is the last item under a term liability. So far we have discussed items like term loans from banks, right? Unsecured loans, share application money, right? And some other term liabilities like term deposits from public, right? Deferred payment rate, debentures, and preferred share capital. So now we'll be discussing at the last item under term liabilities, and then we'll move on to the current liabilities. Deferred tax liability is actually an advanced accounting concept, right? It's an advanced concept. It's actually asked in interviews of higher grades. Usually it's not asked in the lower grades. But then it's an item that appears a lot in balance sheets, right? So people find this deferred tax liability and straight away classify it under term liability. But the concept itself is not known to many bankers, right? Because one, it's an advanced concept, and moreover, it's a confusing topic. So if you find this particular segment a bit advanced, you might leave it, right? This is an optional segment. But just remember in the CMA classification, this will be classified under term liability. Deferred tax liability will be a term liability in the CMA classification. So let us break this term deferred tax liability into individual components: deferred, tax, and liability. Deferred means, right? Usually it means postpone, something related to postponement, right? So deferred means postponement. We need not pay it right now, right? We can pay it later. That's what deferred is. We know taxes. Tax is just a statutory payment to be made out for the profits to the government. And liability, since we are not paying the tax right now, we have to pay it at some point in the future, so it's a liability. We already discussed what a liability is. This is an obligation to pay. Since we have deferred this payment, since we didn't pay it right now, right, in future we have to pay, so consequently it's going to be a liability. So this is the deferred tax liability. So why does this arise? We discussed earlier that expenses and revenue recognition as per the books of account could be different from the income tax portions. This is something which we discussed earlier. Let us assume that in the P&L account of a company, right? Here we have all the income items, and here all the expenses items. So under the expenses item, let us assume that there are totally 20 expense items, various expenses, right? Like raw materials, stores and space, various items. So 20 expenses item under the P&L account of a company. So let us assume that 19 of these items are common in both the case of the accounts prepared as per the Companies Act and also as per the Income Tax Act. There is no difference between these two methods, right? But there is an item, let us say 20th item, and let it be depreciation. And as per the books of account, we are getting depreciation to be 10 lakhs, whereas income tax authorities have allowed this expense to be taken as 20 lakhs. That is the concept clear. So the example we are taking is in the P&L account, under the expenses side, there are totally some 20 expenses in this particular example. So expense 1, expense 2, expense 3, up to 20 expenses are there. So we already discussed earlier, the Income Tax Act allows for different class. So the expenses, the treatment of expenses as regarding what the company does as per the Companies Act and as per the actual IT Act, Income Tax Act, because company has to pay taxes as per the income tax rules. So some expense items can be in the treatment with regard to Companies Act and the Income Tax Act. In this example, we are saying that the difference in respect of 19 items, there is no difference in respect of 19 items. Only in one item there is a difference between the Companies Act and the IT Act, that is the depreciation. So let us assume that for 19 expenses, they are exactly the same. E1 is equal to expense here, let us say P1, P2, everything is same except for one expense, depreciation. Here depreciation we are arriving at one amount, say 10 lakhs as per the Companies Act, whereas as per the Income Tax Act it is 20 lakhs. So let us see what effect this is going to have. So if you see here, this is as per the books of accounts, right? So and this is as per the income tax portions, this is as per the Companies Act, right? So here we are saying the income is same in both the cases, identical, 100 lakhs. 19 expenses are similar in all aspects, so 70 lakhs. The 20th item, the depreciation, is 10 lakhs as per the Companies Act, and as per the Income Tax Act, it is 20 lakhs. So thereby, if you arrive at the profit, you will see that the profit before tax is 100 minus 70 minus 10, in this case 20. And here it's going to be 100 minus 70 minus 20. Here only 10. Here we are getting a lower profit because a higher depreciation was allowed by the Income Tax Act. So consequently, tax is calculated on profit before tax. Let's assume that the tax rate is 30%. So 30% of 20 is 6 lakhs here, and 30% of 10 lakhs is 3 lakhs here. So see the effect of different treatment, depreciation, one as per the books of account and as per the Income Tax Act. By taking depreciation as a different amount in these two cases, you are arriving at a different tax amount, right? Just because you have taken depreciation to be different. Every other expense is same. All the 19 expenses are same. Just one item depreciation is different, and consequently we are arriving at different profit. The tax amount, we are arriving at a different amount. One as per the books of account as per the Companies Act, and one as per the income tax provisions. So as per the Companies Act, we have arrived at a profit of 6 lakhs, right? So whereas as per the IT Act, we have arrived at a tax payable of 3 lakhs. Understand that actual tax is paid as per income tax calculation. The IT authorities have arrived at 3 lakhs. So what the company does is it pays 3 lakhs. So in the process, what happens is, while the books of account is as per the books of account of the company as per the Companies Act, they're showing the tax to be paid is 6 lakhs. You have paid only, thereby the company has ended up paying a over amount in the books of accounts. See, this has to be in the books of accounts. So this has to be accounted for. This is what actually gives rise to deferred tax liability. Actually, deferred tax liability is going to arise in a number of other areas, but in this example we are taking the case of depreciation. The difference in depreciation due to one by the Companies Act and the second due to the Income Tax Act is going to give a different tax amount, right? We are taking that example, but deferred tax liability can arise due to different treatment of any other expense. This example only we are taking, purpose of this example we are taking case of depreciation. So here the Companies Act is saying you have to pay 6 lakhs, whereas Income Tax Act is saying only 3 lakhs. And since company has to oblige the income tax department, whatever it says is correct, it has to pay. So it ended up paying 3 lakhs. But as per the books of account, it is 6 lakhs. So somehow you have to account for the difference. The difference is 3 lakhs. So please the outset, we are going to see the calculation shortly, but at the outset please remember that deferred tax liability, this is a temporary difference. See, ultimately the company has to pay the 6 lakhs. This cannot be escaped. Company cannot escape the payment of 6 lakhs. It has to pay the 6 lakhs. But this above difference is saying it is only differing. Deferred tax liability means postponement. It's just postponement. It's not waiver. You're not going to escape without paying the 6 lakhs. The company has to pay this total 6 lakhs at some day. The difference of this 3 lakhs, company has paid only 3 lakhs out of 6 lakhs. The balance 3 lakhs has to be paid. When it's a different matter, it is deferred, it is postponed, but the company finally is going to pay this entire amount. That's why with this deferred tax liability is a temporary it is a timing difference. It is a timing difference. When the company is paying the amount is the question. Not now, later. It's a timing difference, but it is only a temporary difference, right? Deferred tax asset is the opposite. So here we are taken, the Companies Act has arrived at 6 lakhs and the IT Act has arrived at 3. If the reverse is the case, if the Companies Act has arrived at 3 lakhs while the IT calculation has arrived at 6 lakhs, the company still has to pay as per the Income Tax Act, because whatever Income Tax Act calculation says, the company has to pay. Now the company has paid 6 lakhs, whereas the books of account is saying you have to pay only 3 lakhs. So the company has paid a higher tax amount. This gives rise to a deferred tax asset. Unless we take an example, you are not going to understand this concept thoroughly. So let us take an example, right? We'll take an example. There you will, when we do the calculation, you will thoroughly appreciate the concept. So please refer back to our discussion on depreciation. In the chapter of depreciation, which you discussed in chapter 5 under P&L account, the depreciation, please go to the that particular segment once again, because there we discuss two methods of calculation. One is the straight line method and another the written down value method. Here we are not going to repeat that calculation method. Please go back if you are not comfortable with the calculation. Review that section again, right? We are not going to repeat that calculation part here. We are straight away going to do the calculation. How it is calculated, it is discussed in the earlier segment of depreciation. So if you are not comfortable with the calculation, please go back and review that segment. So let us now assume, that a company, right, is maintaining two books of accounts, one as per the Companies Act and one as per the Income Tax Act. Please note that there is nothing wrong in this. There's absolutely nothing wrong in this. Companies can maintain books of accounts like this, right? One as per the Companies Act and one as per the Income Tax Act. So in the first set of books, that is in the Companies Act, here the depreciation is being calculated as per the straight line method, and in the second set of books, the company is calculating depreciation as per WDV method. Now let us assume the following figures. I'll show you a table. So in the table, this is the profit before depreciation and tax. This is the figure of profit before depreciation tax. PBDT means before depreciation tax, means we start with income and less expenses. Here we taken all expenses except depreciation and tax. Profit before depreciation tax is arrived by deducting from the income all expenses except depreciation and tax. Once you deduct from this PBDT, depreciation and then tax, you'll finally arrive at PAT, profit after tax, right? If you deduct all expenses, you will arrive at profit after tax. That's the final figure. Here we have not yet deducted depreciation tax, so you arrive at what is known as profit before depreciation and tax. So let us see the profit before depreciation and tax from this figure. Here we are saying, so here you can see that the company profit before depreciation tax is a 200 lakhs. This is for 7 years period starting from 2012 to 2018. The company expected to make profit before tax, or let us assume these are all actual figures, right? So the company, the profit before depreciation tax is 200. The depreciation, the first method. So here we are actually assuming an asset is purchased, right? Here we are assuming the company has purchased an asset for 20 lakhs, and the life of this machine is 77 years, right? Life of this machine is 7 years. So the cost of the machine is 7 lakhs, and life of the machine is 7. If you remember the formula for SLM method of depreciation, the depreciation is calculated by the cost of the machine divided by number of years. So here the depreciation will be 10 lakhs per year. So every year you are going to depreciate 10 lakhs, and finally at the end of the 7 years, the value of the machine will be 0. The entire cost of the machine would have been depreciated, right? Would have been depreciated. Here 10 lakhs every year. So that's what we have done here, right? Every year we are deducting 10 lakhs. That's the depreciation. So profit before tax, right? If you see the profit before tax, there are expenses which we till now we did not deduct depreciation tax. Now we are going to deduct depreciation. Let us deduct depreciation. We are going to arrive at 190 throughout or for all years. And tax at the rate of 30%, right? 30% of 190, 57. Then you arrive at what is known as profit after tax. So this is as per the SLM. If you follow depreciation as per SLM, you arrive at the depreciation of 10 lakhs every year. Accordingly, you arrive at the profit of 133 lakhs for all. Let us do the same calculation for WDV. In this WDV method, let us assume that the company is assuming the depreciation rate to be 20%. Let us first of all calculate the depreciation, right? First of all, do the depreciation. So depreciation, if you remember the calculation, this is how we do the WDV depreciation. You start with 70 lakhs, that is the cost of the asset. In the first year, 20% is the depreciation rate. So 20% of 70, that is 14. Closing written down value will be 70 minus 14, 56. In the next year, the 20%, the depreciation will be 20% of not 70 as in the case of SLM, but 20% of the written down value, 20% of 56, that will be 11.2. So now the fresh WDV for the second year will be last year the WDV 56, which will be the opening for this year, minus depreciation, so 44.8. Next year the depreciation will be 20% of 44.8, 8.96, and the written down value will be last year's WDV 44.8 minus 8.96, right? And this goes on. So here you can see the depreciation values. Earlier under SLM value, we arrived at a depreciation of 10 lakhs every month uniformly. For all the 7 years you got 10 lakhs, but now you are getting 14, 11.2, 8.6 and so on like that. Please remember this last year. This is something which you already discussed. So in the last year we are going to straight away take the previous year WDV and directly take it as depreciation, because otherwise the machinery WDV won't become 0. So when we are saying that the life of the machine is 7 years, obviously the written down value should become 0, right? But in WDV the WDV, in this WDV method, the value will not become 0. So it will keep on decreasing but never becomes 0. To make it 0, manually what we do, we take if the life of the machine is 7 years, we go to the 6th year, we see what is the WDV and straight away put that amount in the depreciation. Thereby the WDV will become 0 at the end of the 7th year. You see here the depreciation, therefore in the case of SLM it is 10 lakhs throughout, it is these values, right? We are not going in detail about the calculation, you are aware of this. If not, you please review the section on depreciation once again. So once we got the depreciation as per WDM, this is the depreciation which you got on the WDM. So now you can arrive at the profit after tax. So PBDT is already 200, which you discussed. Now this is depreciation. So this is profit before tax, 200 minus 14, 186 and so on. Tax at 30%, 30% of 186 is 55.8, and finally we arrive at the profit after tax. So now we have arrived profit after tax based on two methods, one as per the SLM and the WDV method. Let us put them side by side. Right, so these are the two calculation methods. This is as per the SLM. Under SLM, taken depreciation of 10 lakhs and depreciated the, right? So you arrive at a profit after tax of 133 lakhs every year. As on the WDV method, this is the depreciation which you got, and this is the profit you got. It's a difference in profit. See, this is 133 lakhs throughout. This is started from 130, and these are the figures, right? So now let us see the portion. You see here the tax was 57 lakhs. Here it is the amount. Let us put this side by side. So in the next slide you can see we are placing them side by side. You see here in the first year the company has paid a tax of 55.8. Remember, the tax payment is always going to be done as per the Income Tax Act. So this is the books of account. This is tax calculation as per Books of Account, Companies Act. This is as per income tax rules. So here, firstly, the company has paid a tax of 55 point. But you see, as per the books of account, the company has to pay 57 lakhs. So thereby, the company has made a shortfall. So they will arise a deferred tax liability of 1.2 lakhs. This 1.2 is the difference between 57 lakhs and 55.8. So there is a less amount paid. Right? So when there is a amount to be paid, when the amount pending to be paid, it will be a liability. So this gives rise to a deferred tax liability of 1.2 lakhs. In the cases where it is opposite, right? Say for example, here books of accounts is 57, whereas company has actually paid more, 57.31. So in this case, they realize a deferred tax asset, right? So where the opposite, that is where the company has actually paid more tax than for the books of account, it will create a deferred tax liability. So here this is 1.2 deferred tax liability. Let us see what is the deferred tax liability for the remaining year. So the first year it is 1.2, we just seen 57 minus 54.8. Second year is going to be 0.36. Third year there will be a deferred tax asset, as we discussed, because the actual tax is greater than the accessible books of accounts. Deferred tax asset. For the next 4 years we have deferred tax asset. Finally we have deferred tax liability. So this is the scenario. So some years we have deferred tax liability, for some years we have deferred tax asset, right? Let us do the netting. Right, let us do the netting. This is the same figure, this is the same table as per the previous slide. So here for some years we have deferred tax liability, for some years we have deferred tax asset. Now let us do the netting and do the accumulation. So here 1.2, first year is 1.2, second year 0.36 is the deferred tax liability. So if you add up the last 2 years, 1.2 plus 0.36, this is about deferred tax liability. So there will be 1.56. In the next year, deferred tax asset is you can see 0.31. So therefore you can subtract. We're doing the netting here, right? See, we are arriving at one single figure. So cumulatively deferred tax liability was 1.56, whereas deferred tax asset we now have 0.31. So netting, if you do the netting, deferred tax liability will be 1.25, right? This is the netting. Again in the next year 0.85 is deferred tax asset. If you net it, you will get deferred tax liability of 0.4. The next year 1.28. So now you are going to get deferred tax asset. Till here you got deferred tax liability net, but now you are going to get deferred tax asset 0.88. Next year again deferred tax asset 2.5, netting, right? Finally is going to become 0, right? If you do the netting till the 7 years, what you're going to get is tax is 0, because I already told you deferred tax liability and deferred tax asset are just temporary differences. Ultimately it will become 0. What I mean by this is, if you take up a calculator and just add up, this tax as per the books of account. 57 into 7 years will be 99. Just take up a calculator and add up the tax as per the income tax rules. You will still get 399. Point I'm trying to make is, you cannot escape the tax payment. Ultimately the company has paid 99 lakhs. In both the cases, please remember, in both the cases the company did pay 399 lakhs ultimately. The timing was different. See, in the first example, every year it was paying 57 lakhs, whereas in the second example, in the first year it paid a lower amount. Again in the second year it paid a lower amount. In third year comparatively it was a higher amount, and so on. So there is a timing difference here, right? There is a timing difference as to when the tax was paid, but ultimately the company did pay 399 lakhs in both the cases. So this is a temporary difference. Ultimately if you do the netting, it will become 0. In other words, the tax payment in both the methods will be same, right? At the end of the 7 years, if you take the total tax payment will be same. Only the timing will be different. In which year the company made, payment will be different. So deferred tax liability will ultimately become 0. So if we add up the tax as per the both methods, will be 399 lakhs. So it's only a timing difference. So we just discussed the basics. There are a lot of intricacies in this concept of deferred tax liability. We're not going to into it, but I hope you got a preliminary understanding about the topics, because this is a topic which many bankers are not very comfortable with. In balance sheet, when they see an item called deferred tax liability, they straight away classify it on the term liability in same way, which is correct. It is the classification wise. Deferred tax liability is a liability. If you get a deferred tax asset, we're going to discuss later, it's going to be a non-current asset. But the classification is alright, but you should also be aware of the concept of why this is arising. Now now you have the basic knowledge of what this item is about. You can be very proud of that fact, because not many bankers actually know this term very well. It's a interview question asked for senior bankers. Not many will answer this, right? This is a very advanced concept. So you have some basic knowledge about this concept. We come to an end of the segment. So in the next segment, in 6.10, we'll be starting a discussion on the current liabilities. So with this, we have completed the discussion on term liabilities. In the next segment, we'll start a discussion on current liabilities.